What if one of the smallest amounts of money you spend today could become one of the biggest financial decisions of your life? $4. That's it. Not $400, not $4,000, just $4. But give that $4 enough time and something extraordinary can happen. Because the real power isn't in the $4, it's in what happens when money gets decades to compound. And by the end of this video, you'll see exactly why time may be one of the most valuable assets an investor can have. Think about the last time you spent $4. Maybe it was a coffee, a snack, a small convenience purchase. Maybe it was an amount so insignificant that you didn't even remember spending it. That's the strange thing about small amounts of money. We notice $400, we notice $4,000. But $4, our brains often treat it like background noise. And that's where this story begins. Because $4 once doesn't matter very much, but $4 repeated consistently is a completely different number. $4 a day is approximately $460 a year. Over 10 years, that's $14,600 contributed. Over 20 years, $29,200. Over 30 years, $43,800. And over 40 years, $58,400. No investment growth included, just the money you put in. But here's where things get interesting. What happens if that money doesn't just sit there? Imagine that instead of allowing that $4 to disappear into small purchases, you redirect it toward a diversified investment. For this example, let's use a hypothetical annual return of 10%. Not a promise, not a forecast, just an illustration of what compound growth can look like over a very long period. And we're going to assume the money is invested consistently. No perfect market timing, no magical stock picks, no overnight wealth, just contributions, time, and compounding. Now watch what happens. After 1 year, you've contributed about $460. At this stage, the investment doesn't look life-changing. And that's exactly the point. The beginning is usually boring. You put money in, you wait, the market moves, sometimes up, sometimes down, and nothing dramatic seems to happen. But something important is happening underneath the surface. You're building the first layer of the snowball, and the snowball doesn't need to look impressive yet. It needs to keep rolling. Now, fast forward 10 years. You've contributed approximately $14,600. But with hypothetical 10% annual compounding, the account could be worth roughly $30,000. That's more than twice the money you personally contributed. And this is where many people misunderstand compound growth. The money isn't simply growing because you're adding more. It's growing because the money you've already invested can potentially generate returns, and those returns remain invested. Then, those returns can potentially generate more returns. The process begins slowly, then it accelerates. But 10 years is still only the beginning, because the real difference appears when time starts stacking on itself. 20 years, your total contributions, $29,200. Under our hypothetical 10% annual return assumption, the investment could be worth roughly $91,000. Look at the difference. You put in less than $30,000. The account potentially grows to more than $90,000. Then that means the majority of the balance isn't simply money you deposited. It's growth. And this is the moment when the math starts becoming difficult to ignore, because the investment is no longer grow-inch, primarily because of your daily $4. It's increasingly growing because of the money that came before it. But we're not done. Not even close. Here's the part most people underestimate. The first decade doesn't look spectacular. The second decade looks much better. But the third decade can completely change the picture. Why? Because compound growth is not linear. You're not earning returns only on your original contributions. You're potentially earning returns on previous returns as well. It's growth building on growth, and that creates an accelerating curve. This is why two investors can contribute similar amounts, but end up with dramatically different outcomes simply because one started earlier. Time doesn't just add another year. It gives every previous dollar another opportunity to compound, and that is incredibly powerful. After 30 years, you've contributed approximately $43,800. Using the same hypothetical 10% annual return assumption, the account could be worth roughly $276,000. Read that number again. You contributed less than $44,000. The hypothetical account value is more than $250,000. The difference is the result of time and compounding. And this is where the $4 starts looking very different because $4 doesn't look powerful when you spend it once, but repeated consistently over decades, it becomes the seed of something much larger. Now, 40 years, you've contributed approximately $8,400. Under our hypothetical 10% annual return assumption, the investment could grow to approximately $774,000. That's the number, $774,000. But don't misunderstand what that number means. You didn't contribute $774,000. You contributed around $58,400. The remaining growth comes from the hypothetical investment returns compounding over 4 decades. And that's why compound growth is so fascinating. The biggest part of the journey happens near the end. Now let's make this more realistic. The market doesn't move upward in a straight line. There will be crashes, corrections, recessions, years when your portfolio loses money, sometimes dramatically. Imagine watching your account fall 20% or 30%. After years of contributing, it won't feel good. And that's where many investors make a critical mistake. They assume a falling balance means the strategy has failed. But long-term investing doesn't require the market to rise every month. It requires the investor to have a strategy they can stick with through different market conditions. That's easier said than done, because when your money is falling, your emotions are rising. And that's why the structure of your financial plan matters so much. Imagine setting up an automatic investment. Every month, the money moves without requiring a new decision. No guessing, no waiting for the perfect moment, no asking yourself whether this month is the right month. The system simply continues. That's powerful because successful long-term investing isn't necessarily about being more intelligent than everyone else. Sometimes it's about removing the need to make the same decision over and over again. Your future doesn't need a perfect version of you. It needs a consistent version of you. And here's another important point. Maybe $4 a day isn't realistic for you. That's okay. The lesson isn't that everyone must invest exactly $4. The lesson is about finding an amount you can consistently redirect toward your future. Maybe it's $1, maybe it's $5, maybe it's $20. The number matters, but the combination of consistency and time matters too. A financial plan that you can maintain for decades can be more meaningful than a plan that looks impressive for 3 months and then disappears. So here's the question. The next time you're about to spend a few dollars, don't automatically ask, can I afford this? Ask something different. What could this money become if I gave it time? Because every dollar has a destination. You can spend it, you can save it, you can invest it, or you can lose track of it. The choice isn't always dramatic. Most financial decisions aren't. They're tiny, repeated, almost invisible, until decades later when you finally see what they added up to. Think about where you'll be 40 years from now. You will get there whether you invest or not. Time is going to pass. The years are going to disappear. The question isn't whether those decades will happen. The question is what your money will be doing while they happen. $4 today feels small. 40 years from now, the decision behind that $4 may not feel small at all. And that is the hidden power of time. If you want to apply this idea to your own finances, start simple. Step 1, look at your spending. Find the small expenses that happen repeatedly. Step 2, calculate the annual amount. A few dollars here and there can become surprisingly large over a year. Step 3, decide how much you're comfortable redirecting. Don't create a plan that puts your essential expenses at risk. Step 4, consider automating your contributions. Automation removes friction. Step 5, think long-term. Don't judge a decades-long strategy by what happens after 3 weeks. And remember, investing involves risk. There are no guaranteed returns. So what could $4 become if you gave it decades to grow? Under our hypothetical assumptions, a $4 a day contribution could eventually grow into hundreds of thousands of dollars over 40 years. Not because $4 is magical, not because the market guarantees a 10% return, and not because wealth appears overnight, but because time allows compounding to do something that ordinary saving cannot do as quickly. The lesson isn't really about $4. It's about the direction of your money. Small amounts can become meaningful when they're repeated. Subscribe to Luxbit Capital and turn on notifications so you don't miss the next video, because your financial future is built one decision at a time. This is Lux.